Okay, I think we're about ready to go ahead and get started. Um, Welcome to the morning of the last day of the workshop. I'm looking for Erik Ela. Where is Erik Ela? Oh, there he is, right there. So this morning we're going to get an update on the market evolution, what's happening with markets, and some discussion of how forecasting is affecting the market evolution. We've got a great panel lined up, and I think most of you know Erik Ela. He was with us for the tutorial, gave a great tutorial on forecasting and markets on Tuesday morning with Aiden, and he's going to be chairing our session this morning. So without any further ado, let me turn it over to Erik.
Thank you, Charlie. Sounds like Mike is working well. And I'm going to give a quick introduction. We've got a great panel session today, even though it looks like it's a light session here at the table. We've got 4 great guests on the big screen that will have some great discussion for us today. And we'll also aim to have a good Q&A panel session too at the end. So hopefully bring some questions. We're going to hold the questions until that ending session so that we can have some good, robust discussion with the group. Quick intro from me to get us started talking about this topic. So one of the things we think about, we're a lot of the discussion over the last few days and that we've had at these workshops before are talking about some of the near-term challenges around electricity markets, how forecasting is linked to electricity markets and how are ways that we can make improvements to improve economic efficiency and improve reliability and various other metrics. And I remember a few years ago for the ESIG 100% workshop that we had. It was a great opportunity to look sort of more beyond that. What happens if you have sort of the vast majority of your supply resources have zero fuel costs? And if we do marginal cost pricing, what does that mean in terms of what the prices are, what the outcomes are, whether resources have enough incentive and compensation to stick around? And I think that'll be a big theme of today. So there's a lot of theories out there. A lot of folks kind of say on one side, well, if you put a lot of zero fuel cost resources, that's going to shift the bid stack, and that's just going to lower the average wholesale prices. And you have another side that's saying, well, not necessarily. There could be increase in costs from the capital costs, and all that can be factored in. And I think the big part about those two sides of the debate, as we'll hear from our speakers, is well, it's more complex than that. There's a lot of things that can impact what the revenue of these different resources will be, what investment signals, environmental policies are out there, sort of what payments are outside of the wholesale markets, what resource adequacy structures there are, how responsive demand is to price can play a big part in how those energy prices will result. Things like shortage pricing, where are the renewable resources locating? Are they being overbuilt because of the siting that can happen, or what types of correlation do you have across them? And then also, what's the cost effectiveness of the enabling technologies, particularly emission-free dispatchable resources, storage, long duration storage, things like hydrogen. What's the cost effectiveness of those resources to help manage the system on this future results? So you can see on the bottom there sort of 2 examples of a supply curve. And I think that in reality, once you look at the types of resources that would be filling in some of the gaps, you'll get something maybe perhaps completely different than any of those. I think that's a good discussion for today. Price formation, how will this affect the price going forward? I think there's sort of 4 questions that I think of when we're trying to look at that. One, what is the marginal cost? So if you don't have fuel costs, what does the marginal cost mean? And you have things like opportunity costs, you have things like cycling impacts, you have other aspects. So if we're not incentivizing things like improving your heat rate efficiency or getting cheaper fuel from the fuel markets, what are we incentivizing? What are the types of things that we're trying to do to lower costs? What are the marginal costs of these resources? That becomes bit more complex. What is the value of energy will become very important. So, we use the value of lost load in a lot of our studies, and there's lots of different opinions on what that is. That could become more important, particularly if it's coming directly from consumers, and how that might help align what the prices might be in the future. And of course, we know that the value of energy is different if it's, I lose my electricity for 5 minutes on a, maybe it's a warm day, but okay, maybe my air conditioner goes off for 20 minutes versus, I lose my electricity for 3 days. And that value is going to change based on, the type of customer and these other things. What is the cost value of operational attributes? So we know that there's a lot of attributes that might be necessary on this future system, and sort of valuing those attributes beyond energy can help us understand what those revenue streams might be as these other technologies are providing the attributes and the services to maintain power system reliability on this future system. So if we have energy that's maybe free most of the time, we have all these other services. What's the value of those services? The question comes up. I remember hearing, if you think about, well, if there's a missing bolt on my airplane when I'm in the air, that bolt is worth many millions of dollars. But when I'm at the hardware store, it's still 80 cents, or maybe with inflation these days it's $6 or something like that. But and then finally, how do retail customers understand and react? I think that's a really important part. We're sort of separated out the retail side from the wholesale side in many jurisdictions around the world, and have different ways of pricing for simplicity and customer comfort and equity and other aspects. And how do we ensure that on this future system where we might require our or benefit from our customers supporting the power system needs more and more as we have more variable resources and other things. How do those folks on the retail side get the right signals to respond while also having a lot of these other factors and keeping equity and other aspects maintained as they are today? So those are just 4 key questions. I'm sure we'll hear a little bit more about some of these in our panel. So we've got 4 great speakers here today. Karen Palmer will kick us off from Resources for the Future. Pamela MacDougall from the Environmental Defense Fund will go next. Julian Leslie from National Grid will be third, and then Liam McManus from the Australian Energy Market Operator. And Liam is with us at around 1 a.m. his time. So hopefully folks will give him a nice round of applause for staying up for us all. So good paper there. I'll recommend for folks too, if you have time, that we did a few years ago on some of these different challenges that's out there in the Power and Energy magazine that talks about some of these discussions. So with that, I'm going to hand it over to Karen to kick us off. And for all the presenters, we'll keep to about 15 minutes each, and that should give us some good time for the panel discussion Q&A. So just keep your timer. I'll try not to butt in unless I have to, but we'll try to keep with that 15 minutes. So Karen, if you want to turn your video on and your audio on.
Yes, and can I share my screen? Can't. Okay, here we go. Sorry, apologies.
And if anyone wants to join me on this table, feel free to sit along.
Great. So thanks so much, Erik, for those introductory remarks, and thanks, Charlie, for the invitation. And so sorry I can't be there with you today in Colorado. I bet it's nice. So one sentence about Resources for the Future, where, in case you're not familiar with us, we're a 70-year-old this year research institute in Washington, D.C. that does research and policy engagement activities around environment, climate, and energy to help policymakers and others make better decisions, usually using the tools of economics, but not exclusively. But since we're here today to talk about markets, I thought I'd start with sort of a high level view of what it is that we'd like to have our electricity markets do and sort of outcomes that we're looking for. Erik talked about some of these, but one is of course promoting efficient and reliable system operation in the short run, but also getting efficient investment, which is going to be really important going forward as we transition the system in new generation and other resources that enable reliable operation. And here I just want to point out that modeling suggests that firm energy sources are going to be important for balancing a largely renewable or predominantly renewable system. We also want markets that promote innovation and development of new technologies, new clean energy resources. We want markets that will accommodate different types of climate policies. Despite economists' best efforts, we don't necessarily have what economists think are the first best climate policies, and there may be good reasons for that. So the markets need to enable decarbonization. We want markets that promote efficient electricity consumption decisions, so give consumers the information they need to make choices about when it makes sense to consume and how much. And we want markets that will accommodate the growing reliance on electricity through electrification that we're going to see in the future. So probably don't need to tell people in this audience that our electricity markets aren't currently textbook competitive markets. There are administrative features to them, one of which is price caps that will keep the energy prices from getting too high, and those caps are often below the value of lost loads. So this limits the ability of markets to incentivize the energy markets alone to incentivize efficient investments or efficient conservation when that makes sense, or switching power use, and leads to a missing money problem for the fixed costs of some power plants. The way this is dealt with in several of the organized markets in the US is to have capacity markets that will ensure that there's sufficient capacity to meet peak load. We recently had an event at RFF that featured Todd Agard and Andy Cleet. So here's an ad for their book about capacity markets. And a lot of what the book is about is pointing out that there are issues here. It's not really sure what the theory is underlying capacity markets. They're complex. They may be over procuring, and that's certainly evident in some regions, and also misprocuring the types of resources we need going forward. And they're not really consistent with the shift toward clean energy. Other thing that I mentioned earlier is that our decarbonization policies also deviate from the economist textbook. We don't see carbon being priced in the US outside of RGGI in California, although Oregon and Washington have recently added programs. And when carbon is priced, the prices are lower than what the social cost of carbon would suggest. Or if you want to take an approach that says we should get on a path that will lead us toward our decarbonization goals, they're also not consistent with being on that path typically. So instead, what we find ourselves with is a world where the policies to decarbonize the electricity sector are ones that encourage clean energy use, either renewable portfolio standards, broader clean electricity standards, and also tax credits at the federal level, which are currently still subject of debate. And all of these policies put downward pressure on energy and capacity prices. A good attribute of them relative to pricing carbon might be that they have the potential to limit emissions leakage, particularly if you're talking about state policies from one state to the other. And the other thing to point out, of course, is that if we were only pricing carbon in the electricity sector, that could discourage electrification. Depends on how you use the money. All these policies are complex. So, as again, Erik alluded to it at the beginning, as we move towards a predominantly renewable system, and we are introducing resources that are energy constrained, and that means there's different potential operational challenges. Combining renewables with storage, this can work together to address and reduce those challenges. But in general, resource adequacy moves from a focus on meeting peak demands to a broader focus on meeting energy demand in all hours. And that means the concern is, do we have sufficient energy moving forward? And so market constructs need to encourage investment in resources that are going to meet this challenge and focus on encouraging flexibility in particular. When you think about existing markets and what are the real issues here, I found what I think is a really nice articulation of the challenges that we face in a recent working paper by Jacob Mays and Jesse Jenkins, that really kind of gets at what the risks are. So one thing, focusing on current markets that have these constraints with price caps and maybe operators making decisions that are kind of outside markets. As we rely on renewable and variable resources more, it's going to potentially exacerbate the revenue shortfalls associated with those outside market activities and raise the need for other sources of revenue that the existing resource adequacy structures like capacity markets are not well suited for. And so that's important to keep in mind. On the other hand, moving toward greater reliance on near-term energy markets. So say we solve those problems and we did have true shortage pricing, well, that's going to raise risks for investors and thus potentially the costs of financing, absent some good decentralized mechanisms for long-term risk sharing. And the third issue here is that the need to decarbonize at an ambitious pace means that we're going to continue to need climate policies, and there'll be revenue risks associated with that reliance on that other source of revenue for non-subsidized resources that will be potentially needed to firm up the system and help address reliability. So here I borrowed a slide from a recent article in Science that sort of is intended to make 2 points. One is the graph on the left shows investment in new generating capacity over the past 60 years. And you see that, even in the highest, and then the graph on the right shows needs in terms of average additions to capacity just necessary to meet the Paris goals. And the important point here is that the investment needs on an annual basis will rival the highest years that we saw in the past. So we need to add a lot of resources. And also, many of these studies find that there's a continued role for gas or gas with CCS going forward, at least out till 2030 to help with system firming. So there appears to be a need for long-term markets going forward, and these can be built on existing mechanisms that are used by states and others to procure clean energy resources. These markets would could encourage efficient investment in a mix of resources, basically using competition to procure a mix of resources that meet the clean energy and resource adequacy goals at low cost. It puts downward pressure on capital costs, and they can work alongside the day-ahead and real-time markets that encourage efficient operation. So it's a way of providing a centralized hedging function that can work alongside either state or maybe federal, if we get some more of that, decarbonization policies, or they could internalize these clean energy goals into the structure of the market. Essentially, what we're talking about here is competition for the market, as a phrase that Paul Joskow likes to use, alongside existing SCED markets. With respect to this, I was involved in a project with Carl Hausker and other at World Resources Institute that took 4 ideas, 3 of which were developed in an energy and innovation project that started in 2018, 2019, and built upon those ideas to develop some ideas for what organized long-term markets might look like. The resources from that event are available at these links, and happy to share these slides with folks later. I don't want to talk in great detail about each of these, but just mention a few features that are highlighted in this graph. So we had 4 authors, Brendan Pierpoint, Erik Jimon, Sue Tierney, and Stephen Corneely, and they had kind of very different visions for what organized long-term markets might look like. The first 2 really focus on contracts for forward energy schedules that swap contract revenues for energy prices in the market. And the thinking there is by offering a centralized market, it provides the most liquidity and competition in these contracts, and it will give the best deals in terms of hedging options. Sue Tierney's market model is really different. It is more like a slight modification to existing markets that factors in more types of resource adequacy products than just traditional capacity. All of the first 3 of these would sort of function alongside carbon policies, decarbonization policies. Cornelia's approach is different in that it seeks to find portfolios of resources that will match load and generation in all hours, looking a few years ahead and then updating as time unfolds. What's going to be required to put the energy and other services that you need and provide revenues to folks to make those investment happen, and internalizing the decarbonization constraints. So a variety of different ideas here. I'd invite folks who are interested to look at those papers. But another topic that I want to mention here that Erik brought up that will be even more important in the future is, of course, activating flexible demand. Now, when energy supply is relatively inflexible and storage is expensive, there may be some opportunities available that are low cost to move demand to meet supply. This is talking here about kind of a new form of demand management that's not just about reducing peaks or encouraging efficiency, and I don't want to diminish the importance of those pursuits, but really help to raise the value of renewables and limit curtailment. So flattening these ramps that operators are concerned about and absorb excess renewables and really make the most of them. And I think incentives are important here. So economists have long favored the use of time varying prices to help address peak demand and lower the costs of adding peakers. But in the future, if you have risk of renewables curtailment, you can expect that prices will be lower when renewables are abundant and there is a curtailment risk. So shifting demand to those hours will raise the value of renewables and potentially, hopefully, lower emissions by getting them to operate more. And a recent study by some economists at University of Hawaii compared the welfare gains from real-time pricing, so really hourly pricing of power, in a traditional grid to a renewable grid, substantially renewable grid. And they found that the efficiency gains in the substantially renewable grid of real-time pricing are 4 to 5 times as high as they were in a predominantly fossil grid. So having time varying pricing becomes even more important. Of course, one issue with this is that customers and regulators don't really like dynamic rates. And I think something that can make them more palatable to both of those constituencies would be to introduce more automation, which can sort of facilitate customer response to changing prices by simply signing up for a mechanism that will respond but still meet the customer's needs according to some sort of setup. In order for that to work, it has to be acceptable to customers. Josh Blantz and some other co-authors and I have a paper that looks at this in the context of thermostats that respond to time of use pricing, which isn't perfect time varying pricing, but it is a step in a direction toward that. And in general, we think that having more automation available, either through devices or engaging with aggregators, will make adoption of time varying prices more likely and acceptable to all. Now, one other piece of this important puzzle about flexible demand is that newly electrified loads that we're looking at in buildings and also in vehicles have inherent storage features that may make this even more attractive going forward. So for example, electrification of homes and buildings focuses on major end uses, water heaters, space conditioning, particular heating that I guess is increasingly relying on electricity according to the recent EIA REX survey, and also charging of electric vehicles. And what happens with these particular energy services is you can separate the electricity consumption from the energy service consumption through using these inherent storage capabilities. So that makes these services maybe more price responsive than other electricity uses where, common wisdom is electricity use isn't very price responsive, but could be more so going forward. And using pricing and scheduling to deal with diurnal patterns, absorb renewables, other situations that come up. Perhaps this could be coupled with subscription rates to consumers. So you pay a monthly fee for a certain level of energy services, for example, and a third party manages your load through software and understanding your preferences, and also incentives created by these time varying prices that they would face. Of course, FERC Order 2222 requires ISOs to enable demand resources to participate. So let me just wrap up here by pointing out that a decarbonized electricity grid is going to have an increasingly larger role for the electricity sector. It's keeping electricity costs low and systems reliable are going to be as important as ever. Organized long-term markets can help address risks of revenue shortfalls and encourage investment in the right mix of resources. And exposing customers and load aggregators to time varying prices is more important in a clean energy future than ever before. So let me stop there and stop sharing. Thanks.
All right, thank you so much, Karen. We're going to hold questions. So if you had some questions for Karen, just write them down. We'll have some time at the end for the Q&A. But next, we will have Pamela MacDougall talk to us about some of the things that they've been looking at. So Pamela, the virtual floor is yours.
Thanks. Hi, everyone, and thank you, Karen, for that great overview. I'm Pamela MacDougall. I'm the Director of Grid Modernization at the Environmental Defense Fund. It's a pretty well-known environmental nonprofit that's based out of the US, but does have global reach. I focus specifically on grid integration of distributed energy resources, as well as grid resiliency and hurricane mitigation of power sector. So today I don't have slides. I'm just going to speak for 15 minutes on my favorite topic, which is distributed energy resources and how you can integrate them into the wholesale market and why that's a good idea. And Karen gave a really great overview of some of the issues with clean energy transition. And I think that distributed energy resources are a powerful tool to mitigate costs of transition, improve grid reliability, and as well like empower non-utility ownership of energy resources. And so when I talk about distributed energy resources, in my opinion, there's three main types. First is generation, which is commonly known, such as solar, storage, like solar, wind. Then you have storage, which is like battery storage, fuel cells, electric vehicles as a form of storage. And then load management, which can be like heat management, demand response, other types of demand responsiveness to like a price signal. And the main characteristics that differ from traditional utility scale energy resources is that they're small in size. We're talking in the order of like 1 kilowatt to maybe a megawatt, depending on the country and how that determines a distributed energy resource. They're also shorter in duration for what they can offer their services. For example, if you're using a fleet of electric vehicles, they may not be able to offer 24/7 the full capacity of what they could dispatch. They have limitations. And they also have forecasting limitations on their capabilities, in particular advanced forecasting. And that's, I think, the forecasting aspect of my conversation for this. And that is due to them being weather dependent. You're not really sure how accurate the sun shining is going to be, how strong the wind will be. There's also behavioral issues, such as a fleet of EVs. When are they actually going to arrive? Was there traffic? Does that impact your load flexibility in that way? And then also the visibility of distributed energy resources to a grid operator, because they are behind the meter often at the distribution level. And it's harder for operators to be able to integrate them because there isn't currently an incentive for them to make their flexibility capabilities visible. But as I said, there's a lot of benefits to the integration and utilization of distributed energy resources. You can have a lower grid build out, so you're reducing congestion, peak load reduction as well, which Karen mentioned. You're also increasing resiliency. Something we're investigating in the Caribbean is using distributed energy resources, including electric school buses, to be able to provide backup power to place vulnerable communities that often have long outages due to like the distribution grid being ripped out after a hurricane, for example. And you're also lowering transition costs by providing low cost energy resources as opposed to traditional fuels. We are seeing some higher gas prices and a lot of gas price volatility. And then also in the wholesale market, which Karen has mentioned, looking at balancing, mitigating that duck curve, providing frequency services as well, because we are transitioning to more intermittent power resources, leveraging these behind the meter assets to provide these balancing services are also going to be really valuable and vital for meeting our transition goals. One thing that is a little sad is that despite having a large number of distributed energy resources on the ground right now, we're seeing, for example, a lot of fleets installing solar and storage on their sites to reduce cost of transition and capacity costs, as well as homeowners and buildings installing solar and storage, for example, to mitigate their own energy costs and provide their own backup power. We're not seeing a lot of wholesale participation of these distributed energy resources. And I'm first gonna list out a number of reasons of why I think that is. And I think the main reason of that is that these wholesale markets were designed with the mind of a large generator and large resources and not smaller resources. And so the main things that we're seeing as a barrier for these entry of distributed energy resources is being able to actually provide the services and having access to provide services. With FERC Order 222, you are seeing demand side and distributed energy resources being able to participate, but that's just on the wholesale market and some capacity markets. But some services such as voltage regulation, frequency, some congestion management, peak and ramp reduction services and products are often limited from participating. You're also seeing valuation issues where they're not being valued equitable to traditional resources. For example, a distributed energy resource in New York is valued about 75% of that of a traditional storage capacity resource, despite offering the same service, which can be problematic and reduces their incentive to participate. And then there's also really expensive telemetry and metering requirements that are just unnecessary. If you're offering a day-ahead market service, but you're still being required to install an ISO level meter, that can be extremely expensive for a fleet of EVs that has to put a meter at every single charging point. That is $3,000 up at every service point, where they have really good sub meters within those charging stations that could easily provide the information that is needed to be able to do settlement. So making sure that the metering requirements match the service and that they're leveraging other technologies is going to be really important. And then finally, there's really restrictive entry barriers for small generators and energy resources. This can be through entry fees and exit fees that are very expensive, size limitations for entry, and then also some of the aggregation limitations, such as requiring it to be under a single node, and that limits them to be able to even meet the size requirements to be able to participate. Now, as Karen mentioned and I mentioned, FERC has made some really great steps to move the needle forward to allow distributed energy resources to participate, with like Order 841 that allows like storage access for transmission services, FERC Order 2222, which we're still waiting to see how the ISOs respond to that, allowing distributed energy resource aggregations to participate. However, there is still a limitation that if it's only a load aggregation, that doesn't open the door with Order 2222. But they still haven't addressed the fundamental issue, which is a market design product that is built for distributed energy resources. And to look at how that's problematic in the US, let's just look at the current US 2 settlement market and how that would work for a distributed energy resource or an aggregator. You have the day ahead market, which closes about 24 hours in advance on average and is an hourly product. And then after that, any forecast errors are left to risk for the real-time market. So let's give an example of an electric fleet that wants to provide V2G or like bidirectional charging services on the day ahead market. They have to provide it 24 hours in advance. And basically, if there is a traffic jam, if there's an issue with their operations at all, they're going to have a very large error on that real-time market, even if they know it up to 12 hours in advance. And that's similarly for issues like solar and storage, for example, if there's like a weather change or there's a behavioral operation issue. And that can prevent a lot of revenue prevention for these types of aggregations. So these DARE aggregators have two options whenever they're participating in the current markets. They can either undersell their resources to prevent the risk of them not being able to adapt to the forecast that they offered on the day ahead market, basically only offering a certain percentage of their flexible capacity, or they sell at the full capacity and they run the huge risk of being held accountable to the real-time market cost. And that can make or break a business case. And it also prevents a lot of aggregators from getting financing to be able to provide services. Now, one solution that has been made available in Europe and Japan is an intraday settlement. And the key difference between the intraday settlement is that it can either be continuous or discrete. It's an intraday market that closes about 45 minutes to an hour before delivery. And it allows the aggregators and the distributed energy resources to update their forecast without being held accountable to the real-time market. And it also provides smaller time windows, sometimes between like 15 and 30 minutes. And that's much more amenable to these smaller distributed energy resources that have smaller time windows and also have issues with long-term accurate forecasting in advance. So this kind of service also could significantly reduce the amount of reserves that you need because you're able to optimally use the resources that you have on the ground. And it also provides a guaranteed financial incentive for distributed energy resources to participate. Now, there is some sort of intraday adjustments going on within the US ISOs. For example, CAISO has the FMM, where they do adjustments after the fact. However, there isn't any link to a financial incentive to provide high quality data for the distributed energy resources. So without that financial binding requirement for the distributed energy resources, they're limited to participate and also limited to be able to provide accurate data to ISOs. So a financial binding intraday market can really give them that incentive to find a viable business case, but also provide accurate data for us to provide beneficial and efficient balancing services. So the key to success for designing these types of energy market products for distributed energy resources is one, to have something that is financially binding, two, to make sure that it is close to dispatch so that they can update their forecasts and include forecast errors in their offers and their bids, and then also liquidity. So one issue that we're seeing in Europe with their continuous intraday markets, and by continuous, they continually bid up until closing, is that you could create locational monopolies. And that would be, and you're also seeing issues with first come, first serve, access to transmission, so to incorporate congestion in your bidding. And one way that they have overcome this in like Italy and Spain is to instead offer discrete markets during the intraday. That also allows a fixed time for you to be able to bid opening and closing still within the day without having a continuous operation and update, which can create big price signals and sways, as well as like kill the market for some distributed energy resources. But these solutions have shown that they're having a significant uptake in distributed energy resources. In like Europe alone, in Germany, in Italy, and in Spain, you're seeing an uptake of like 50 to 60% of distributed energy resources participating in the wholesale markets because they've opened up these intraday markets. And as a result, they have completely reduced their reserves and some of their balancing issues that they're accounting for, and lower price swings as well. So I guess the end take of this is that it's not only about giving access to wholesale markets to be able to enable these kind of solutions to mitigate forecasting issues with distributed energy resources, but also to look at what market solutions will work for the types of resources that we're having coming on the market and that we want to be as a part of our energy solution. And ensuring that there is financial solutions and financial incentives that can scale for these types of stakeholders. And I do believe that intraday settlements, in particular discrete intraday settlement markets, are a great way for the US market to ensure integration of distributed energy resources in an equitable way. And that's my talk. Questions welcome.
Great, thank you, Pamela. Lots of great thoughts there. I think also just good to think about how good practice in other regions of the world can potentially be borrowed for good practices here in the U.S. So I think we might start to hear more of that from our next two speakers who are representing some regions outside of the U.S. First, we have Julian Leslie with the National Grid Electric System Operator. So Julian, feel free to turn on your video. Looks like you've got the screen share working there.
Well, good morning, everybody. It's a great pleasure to be with you this morning. Sorry I can't be there in person. I would have liked to have been, but my schedule didn't allow for it. So I'm just going to talk about what we're finding here in Great Britain and some analysis we've recently done on the current market situation in GB, some of the issues that is creating, and what our recommendation is going forward. I guess to be clear, just to give some background context, I'm not sure how familiar everybody is in the audience, but National Grid Electricity System Operator is an independent, legally independent system operator function as part of the National Grid Group. So we are legally separate and independent, and in the next 18 months, we will be fully independent and become a public corporation sort of owned by the government. So pretty much a bit like the ISO model that you guys have over in the States. So in GB today, we have a national market with a national wholesale energy price. And then we have the balancing mechanism, which we use in the control room in order to balance the system second by second, minute by minute, and to procure the grid services that we need to ensure we have a safe and secure system. However, the market that we have today isn't really giving the clear investment signals that are needed. And that is investment both in the generation side, but also more importantly, I think, in the demand side, that there isn't that clear signal with a single wholesale energy price and the actions we take in the balancing mechanism. It is not clear to investors or to the transmission owners where the investment is needed. We end up in a position in 2030 that more often, or as equally often as not, we will have more renewable energy on the network than we do have demand to consume that energy. And therefore, we need ways in which we can move the demand to meet the generation, both within day and across days and weeks, and possibly even months as well. But again, there is no incentive today to help to balance that flexibility with the generation, because again, you've got this single wholesale market price, so it doesn't give the incentive signal that if you're a large demand take, to situate yourself close to where there's lots of renewable generation. Which brings us on to the last and the third point, which there is no locational signal. We have very limited locational signals through the transmission network user system charge, which is based on a sort of distance from load, physical asset cost basis, but not a market basis. And what we're finding here in Great Britain, we have a huge and very valuable wind resource up in the north of Britain in Scotland. And that gives a good signal for the wind to locate itself there because it's got good wind load factors, it's got good access to land and to water for offshore wind. But what the market doesn't do today is make the commensurate signal for load centres, so data centres, hydrogen electrolysis, new industrial sort of decarbonised loads to shift into Scotland to consume that generation where it is produced. And therefore, if we don't change the market, we end up with two problems. One is we need to spend billions of pounds in investing in the network to move that power from Scotland and other remote parts of Great Britain to get the power down to where our load centres are in the southeast, sort of around London and that more densely populated part of the nation. So we either, as I say, spend lots of money on building new transmission assets, or we have to spend lots of money in curtailing the wind on those windy days. And at the moment, we're spending about £1 billion per year, so just over $1 billion per year on curtailing wind. And that rises pretty exponentially over the next few years as more and more wind connects in the north of the nation, but long before the transmission assets that are required to reduce those constraints can be consented, built and commissioned. So the consensus of all of this is that we sort of triggered a piece of work that said we need to look at the market, because we could just build more transmission. We could manage the congestion cost using the balancing mechanism. We could find other ways to incentivize big demand centers to move to the north of Britain. But actually, is there a better way by reviewing the market and saying, can we get the market to make some of these decisions for us? So, as I've said already, the constraint costs are rising at dramatic rates. I mean, there were £1 billion in the year just gone. The year before that, there were £400 million. And the year before that, there were a couple £100 million. So you can see we're on this strong trajectory of increasing congestion costs. And that is because we've got very clear and strong government support for decarbonisation, which is funding or subsidising these offshore wind. We have very, very aggressive environmental targets set by the government, which the industry on the generation side is responding to very rapidly. But the planning and consenting and building of transmission lines takes much longer than it does to build a wind farm. And hence we're getting these huge and rising constraint costs. Because we have these constraints on the system, it means we're having curtail wind on a windy day to procure gas further down in the system in order to maintain the system balance. So this is becoming more and more challenging. And back in the day, back in the 90s, the market would pretty much solve all of our problems and we would just balance the last 5 or 10% using the balancing mechanism. There are days now when we're up to 65, 70% of the market we need to interfere with using the balancing mechanism to readdress the balance such that we can operate that safe and secure network. What we're also finding as well is where we do have flexible assets, whether that's some large scale sort of battery storage, etc., that they don't always operate in the way you would expect them to in responding to market signals. So you would expect that storage would be consuming energy at time of high wind factors and exporting when the wind is low. But obviously the wind can blow for several days at a time, whereas you've got a 2-hour, 4-hour battery, then obviously that's on a 2-hour or 4-hour cycle, and therefore it wants to participate in the market and provide services in those intervening times, which does mean that therefore they could exacerbate those constraints on the system. And I think most importantly, the current market doesn't leverage the potential that is out there of shifting demand as our homes become more efficient, as we have electric vehicles on our drives, as we move in GB to electric domestic heating. We should be able to have a marketplace that really values and recognizes the flexibility that by shifting your charging period for your vehicle, by bringing it forward a couple of hours or pushing it back a few hours later into the evening, actually reduces the demand on the grid and helps to balance that generation and supply issue. But at the moment, there's no value in that flexibility driven by the market, so that needs to be addressed. So our approach is sort of reviewing what the answer should be. We initially focused on those operational elements, the constraint management, the voltage management, inertia, all those other things. And then we used an assessment based on a set of criteria that we laid out to assess the different market models to get to the best solution that we believe works in the UK market. The results of all of that is that we believe that nodal pricing, along with central dispatch, did score the highest overall. And therefore our recommendation to the market, well, to BEIS, so the government, the UK government, and to Ofgem, the UK regulator, is that we should look to move away from the market we have today. And our recommendation would be that nodal pricing with central dispatch should be something that is explored more thoroughly and should be sort of moved towards the sort of implementation of that. It's got to be very clear that this is not the ESO's decision. This is the government and Ofgem, the regulator's decision. But we have been sort of proactive, looking at the market, doing our own investigations and working out what our belief is and what our sort of conclusion would be. So the conclusion of all of this is that the status quo will not deliver net zero effectively or efficiently, because the most efficient solution to this is getting this real-time dynamic locational signals through nodal pricing, combined with central dispatch, so we get a real efficient sort of dispatch algorithm, and that this has the highest potential to deliver significant consumer benefit and provide greater competition, and look at that whole system co-optimization. And I think by giving that very clear locational market signal, It gives you the, as you know, it gives you the price of the next megawatt of a particular node, but also more importantly, I think in a GB context, the price of the next megawatt of demand. So we have periods now where we have, even on a national basis, we have negative pricing for 6, 7, 8, 10 hours is the longest, but every year that gets longer and longer as we get more and more wind connected to the system. There's a huge market signal there that if we had a nodal pricing, we would have negative pricing at many, many nodes much more often. And that would allow the data centers, which are currently congregating around London, because that's where the skilled capability resources are, but actually would have forced those data centers to rethink their strategy. And actually, could they locate further north in the country and take advantage of the skills and capability north in the country and get access to cheaper, low-cost electricity, which not only gives them a low-cost benefit, but also helps us in how we manage and how we think about managing the network. So what are we doing next? So we are looking into our what we call BP2, so our business planning for the next 2 years, so 2023 out to 2025. We are putting in there a request that we should get the funding from the regulator to allow us to do a detailed assessment of the nodal pricing and central dispatch design, and really think in detail about the implementation of that, including the impact on stakeholders. Because for many people, this is a huge win, and it really gets hydrogen and other sort of big demand takes onto the system. But obviously, if you're a wind farm developer in Scotland at the very north of the country, you might be very nervous about this type of nodal pricing because you're not sure what it's going to do to your future revenues and costs of operating your power plant. So we need to really understand all of that, make it clear that transmission investment is still required, that this nodal pricing model doesn't remove the need for transmission investment. We have a huge growth in renewable energy. The renewable energy is most efficiently produced where it is most windy, and you've got good access to land and sea. So we must recognise all of that, and so that those projects still come to market. But what we really want to do is encourage this whole energy system solution, so that other energy vectors who are also looking to decarbonise locate in the right places next to the renewable sources and make sure we get that whole energy system solution. The other piece of work we're really going to do then, once we've done all of that, is to also assess other market design elements and how they would work alongside or with the nodal pricing and central dispatch model. You can see them listed on the slide there. And I think the important thing is sort of the ancillary services, which is really my core expertise around the pathfinders that I spoke about yesterday, and many of you I'm sure have heard of. But how do you get those ancillary services, those grid stability services? Do we continue doing long duration procurement strategies as we are doing today, or actually can we find that the nodal pricing and central dispatch model, there is a way to get those ancillary services built in to the market design from day one? And then finally, of course, as I said already, this is not an ESO decision that we can make, but we will support BEIS, our sort of energy department within UK government, and Ofgem, the regulator, in respect to their reform work. They've got a programme running called REMA, and we are obviously heavily supporting that and giving our views forward. So it was a very quick canter through what it is we're doing and how we're potentially changing from the wholesale energy price, national wholesale energy price with a balancing mechanism, through to something more akin to which I know many energy markets within the US already have, but really thinking about those in a UK context. There's more information. We have a dedicated webpage, so if you're interested to look at our analysis and why we've come to this conclusion, then all the information that you would need is on the ESO website, and there's an email there as well where you can email the team directly. So with that, I'll hand you back. Thank you very much.
Thank you, Julian. So our last speaker today for this panel is Liam McManus, who is with the Australian Energy Market Operator. And Liam's going to talk to us a little bit about some of the integration of forecasting and market in Australia. So Liam, if you want to turn on your video, if you would like, feel free to do that. Looks like your slides are showing up good.
Yep, let me do that quickly. I've lost the control bar. There it is. Start my video so you can all see me. Hello. All right, we're all good. Yeah, thanks for having me, everyone, and thanks for listening. I'm going to take you through a little bit about the forecasting that we do at AEMO and make a few comments about the market evolution in Australia and some proposed changes to the market design. I work as an operational forecaster at the Australian Energy Market Operator here in Australia. My day-to-day job involves managing wind, solar, and demand forecasts and providing support to our control rooms. I've also had experience in long-term forecasting and market design at the organisation. But today I'll really be tackling this issue from the view of an operational forecaster. Before I get into my slides, I'd just like to do an acknowledgement of country. This is something we do in Australia just to pay respects to the Indigenous peoples here, and we acknowledge the traditional owners of country throughout Australia and recognise their continuing connection to land, water, and culture. So what is AEMO? AEMO is the Australian Independent Energy Market and System Operator. We operate electricity and gas markets on both the west and east coast, and we're a member-based not-for-profit, similar to, I guess, some of the ISO models that you find throughout the world. I'll just quickly touch on the electricity markets that we do have in Australia. I will be focusing today on the NEM, the National Electricity Market on the East Coast. That's where most of my expertise and my experience lies, but I'll also touch on the Wholesale Electricity Market, or the WEM, on the West Coast for a bit of a comparison. So the WEM's an isolated market. It has no interconnection to any other region, and as a result, it operates as a capacity market. The generation there is about 80% thermal fossil fuels and about 20% renewables, which is mostly rooftop solar, large-scale solar and wind, and it services about 1 million customers. The NEM is about 10 times the size of the WEM in both capacity and customer-wise. It's a long stringy grid and is made up of about 5 former state grids that over time have been built up and interconnected into a single system and market. It operates as an energy-only market with a 5-minute spot dispatch. Generation here is about 70% thermal fossil fuels and 30% renewables, 10% of which is hydro. So renewable energy has increased considerably in recent years in both of Australia's electricity markets. And as renewable penetration in the grid increases, so does the requirement for accurate and reliable forecasting. And as the system and market operator, AEMO is facing a wide range of challenges in this space. So during this presentation, I'd like to step through both the demand and supply side of those challenges. And kind of go through a bit of detail at the end about some of the proposed changes to our market design here in the national electricity market to kind of account for it. So first up is demand, and specifically variability in demand. So in Australia, demand is considerably more responsive and variable than it ever has been, primarily thanks to our world-leading take-up of rooftop PV. We're now seeing rooftop PV generation as the biggest source of variability when we're trying to forecast electricity demand in the operational horizon. So that's out 7 days ahead. Rooftop PV has recently reached 15 gigawatts of capacity, and collectively it's easily the biggest generator. It's actually 20 times the capacity of the single largest unit if you're looking at it collectively. It's distributed, it's not readily visible to AEMO, and it does not participate in any scheduling processes. Instead, it's a completely forecasted resource which is passive and just spills into the grid. And AEMO began producing dedicated forecasts for it back in 2016. And now these rooftop PV forecasts play a real key part in operating both the system and the market. The growth of rooftop PV has had a profound impact on consumption over recent years. And in reference to this chart, you can see our record keeping in the region of South Australia for minimum operational system load. And over the last 4 or 5 years has rapidly approached that 0 megawatts of operational load. So the current record sits at 104 megawatts, and that's in a region that typically peaks in summer at about 3.3 gigawatts of peak demand. So it's a very, very slim margin when you think of it in that perspective. The periods of low system load also result in challenges with maintaining a secure power system. And so forecasts for low minimum demand have become a real key focus area for my team, the operational forecasting team. The demand forecasts that we produce are a real key market signal, and they're key inputs into the market processes such as scheduling. So they present a scenario of what demand would be given current inputs and with no intervention by the ISO or AEMO. And we're seeing variability in solar generation, industrial load activity, and market response can really impact the demand forecast accuracy and impact the efficiency of that market signal. Probably the biggest driver of variability in demand is cloud cover. Cloud cover can lead to variability in rooftop PV generation and be highly uncertain even within the day ahead timeframe. Cloud cover is one of the most dynamic of weather concepts, and it can be very difficult to forecast. And in Australia, we've seen events where cloud cover passing over a capital city results in large ramps in demand that the rest of the generation fleet has to meet. Another major source of variability is market response, non-scheduled market response. So in the NEM, we have a few generators that provide AEMO with real-time SCADA data, but they don't participate in the central scheduling process for technical or other reasons. These generators are effectively considered as negative load, considering they generate and then reduce the demand that scheduled generators need to supply. And so in this diagram here, you can kind of see our dark purple line and our light purple line, and they kind of converge around the middle of the day. There are occasions when non-scheduled units will reduce their generation to zero without any notice, and that's that dark purple dropping off. They have the effect of reducing operational demand into what we call scheduled demand, which the scheduled generators have to meet. And so when they drop off without notice, it's often in response to negative market prices. So the NEM has a price floor of negative $1,000 per megawatt. And this unexpectedly increases the demand that other generators need to be able to service. And while this is generally a positive outcome, because it comes at times that excess generation is not required, it does appear to the market as a demand forecasting error. And as I touched on earlier, forecasting really low minimum demands is a focus area for us. And when some of these generators decide to turn off unexpectedly, that can making a decision on when to intervene in the market to ensure system security quite difficult. And that obviously comes with cost. Another form of market response is demand side response. So when I differentiate between these, I think the key difference is really comes down to visibility. So we have visibility of some of these large non-scheduled units. We have very limited visibility of demand side response. Some industrial loads may choose to reduce their load in response to high prices in the market. And this again is more unexpected behavior, which impacts the demand forecast and the demand signal. But there has been a recent change to the market design to encourage industrial loads to schedule their load reductions, and they would get paid the market price for this reduction. So this is wholesale demand response. The volume they get paid is based off a baseline for the load, which they would have consumed. And we're hoping that this mechanism helps to alleviate some of this impact of demand response on forecast accuracy. So what AEMO as the ISO is seeing is that we need greater visibility of the demand side, so we can continue to accurately forecast demand and send the best possible signal to the market for scheduling generation. Speaking of generation, the supply side is obviously the other side of the coin. The NEM has about 18.5 gigawatts out of 65 gigawatts of its total capacity, which is made up of large-scale solar and wind. And AEMO has the responsibility of producing forecasts for all of it. That currently sits at just greater than 150 farms. And at last count, our systems produce 2.5 million wind and solar forecasts a day. And that ranges from 7-day ahead forecasts, which we use for resource adequacy assessments and outage planning for transmission lines. 1 day ahead for use in an expected price and dispatch, which we call pre-dispatch, which gives generators an indication of the next day's prices and what they might be scheduled for. And we also produce 5-minute ahead forecasts, which are used in 5-minute dispatch. And obviously there's a bunch of intervals in between. All else being equal, as the penetration of these intermittent generators increase, we're expecting to see greater variability and greater uncertainty in the power system, and this poses a real challenge. I thought I would step through what does this forecasting challenge look like for us and for the market. Well, essentially, it looks like multiple fleets of resources coordinating. So this is a day in the region of South Australia, which has some of the highest renewable penetration in the NEM. And there's kind of 3 stages to the day here. You've got the morning period, the early morning period, where we're generating with gas and we're importing from the neighbouring region through the interconnector to meet demand. And then we transition into midday, where solar generation begins to ramp up, noting that most of that supply is rooftop PV in the very light yellow. And AEMO in this region in South Australia will direct gas to stay online for system security. And often during the middle of the day, when solar and rooftop solar and large scale solar are generating strongly, that generation is exported. So that's kind of the generation you can see in grey below the line. And for a period of time on this day, for about an hour, rooftop PV and grid scale solar supplied all of the demand in the region, with that excess wind and gas generation being exported into the neighbouring region. And then the last phase is night. So when the wind generation begins to ramp up, solar is no longer there, and the gas generation can ramp down as wind begins to generate the majority and deliver the majority of the demand. While again still exporting that essential gas generation for system security to the neighbouring region. Many people in Australia argue that this mode of operation is not efficient and should not be the enduring model, because we're essentially directing more expensive gas generation to generate, which they do get compensated for. But at the same time that we're doing this, the market price could be large and negative. It could be towards that negative $1,000 per megawatt hour. And because there's a large number of other generators that are trying to compete to supply a very low operational load, like you can see in this diagram with the black dotted line, it becomes quite a challenge. And it has, the incentives there for the market generators are a little bit skewed. And so the sources of generation are also extremely variable. And so operating a system like this on a day-to-day or week-to-week basis also requires a fair bit of confidence in your forecasting ability. So you might come with a question that says, well, why can't the ISO just improve its forecasts? And well, yes, we can to some degree, and we constantly work on that. But forecast improvements by the ISO are not the only solution. Recognizing this, about 4 years ago, AEMO kicked off a program to provide participants with the option of producing their own forecast for use in the 5-minute dispatch process. Participants have a direct financial incentive to reduce their dispatch errors, as these errors accrue a frequency regulation cost, which they need to pay. So this program has delivered an accuracy improvement above and beyond AEMO's wind and solar forecasting systems, which you can see there in the purple. And we've welcomed these new forecasters in this space, as the benefit that they have delivered has delivered a benefit not only to participants, but to the broader market. And it's delivered a greater certainty to AEMO. Our dispatch errors are lower, meaning we've got greater control of the power system. And as of May this year, approximately 40% of those 150 farms were participating in providing self-forecast. And so the next step of this is, at least for AEMO, is to begin improving how we forecast over the interday and intraday horizons. At multi-hour and multi-day forecasting horizons, there can still be large errors. And in a high VRE system, large errors can result in operational and market issues. And so the next phase for us will be really trying to improve on that that forecast accuracy, and we might even be employing a similar approach here, where we essentially hand back the option to participants to produce a forecast for themselves. Lastly, I'd just like to cover off a few of the proposed changes to the market design.